All right, everybody, welcome back to another Jay Athens video. And in today's video, we're going to talk about something very interesting. This is a topic that is probably talked about a lot within the Forex market or the markets in general. And today, we're going to talk about why traders lose money day trading. That's what we're going to talk about. So the title of this video is called You Will Lose Money Day Trading. And we're going to talk about why. All right, so as you can see, we have a chart in front of us. All right, let me set my chart up. We have a chart in front of us. We're looking at the pound yen. So we'll use this chart as an example of why day traders lose money. All right, so right now in the markets, we have, I don't know, it's a funny feeling in the markets. I've been saying for the past couple of weeks, maybe months, that the dynamics of the market is going to change. So what do I mean by that? I mean, we have a lot of new traders entering the market, and a lot of new traders that's fairly new. And when I say new, maybe 6 to 8 months. And we're having an influx of those types of traders coming in. So when they come in, what are they going to do? They're going to learn what we call technical analysis. Is there anything wrong with technical analysis? No, it's a part of trading. So we're not going to completely downplay technical analysis. We're just downplaying the fact that you think technical analysis is the god of trading, when there's so many aspects that come before technical analysis. And my personal opinion, you're losing money because you only focus on technical analysis. Now, when I say losing money, I don't mean today you wake up, you take a trade, you win. Tomorrow you wake up, you take a trade, you win. The day after that, you wake up, you take a trade, you win. So guess what? The dopamine kicked in your brain. So you start to feel good. You think you're having a good week. Okay, you might be having a good week for those first 3 days. When I say losing money, I mean at the end of 12 months or maybe 6 months, are you net positive or are you net negative? Are you are you in the red or are you in the green? That's what I mean when I say losing money. I don't mean when you're having you're on fire for 4 days straight. Because guess what happens? That fifth day, because of the way you trade, that fifth day you can blow it all. Right? You can definitely blow it all in the fifth day and start right back over. So let's get more in depth to this video and talk about why day traders lose money. One, if you're over leveraged, which a lot of traders are, right? Why are they over leveraged? Because they're trying to chase fast money and don't realize the Forex market is just another avenue for you to invest your money, just like real estate, just like equities, just like treasuries, just like commodities. Those are all different avenues. Why is it that if you decide to become an investor into equities, everybody has a Warren Buffett mindset then? But as soon as you come into Forex, things speed up because they're giving you the power of leverage. Don't abuse leverage. A trader with high leverage is most likely, or nine times out of 10, are greedy, because what they'll do is over leverage, gain about 20 pips on a very high leverage account, and then guess what? They make thousands of dollars. They take the screenshot, they put it on social media. You think they're a good trader. So why? Let's go back to the title of this video. Day traders will lose money. Now let's finally get into it. Forget all the talking. Let's get into why day traders lose money. So we're looking at a chart right now. We're looking at the daily chart on the pound yen. All right. So let's let me pull up a whiteboard and let's break this down. So let's say we have two traders, trader one, trader two. Trader one, we'll say he leans more to the technical side of things. All right. Trader two, he understands technicals, but he leans more to the fundamentals. All right. Now, let's take a look at things now. Fundamentals, technical trader. One is a day trader, all right? Most likely a technical trader is a day trader or an intraday trader. All right, and then we have the fundamentals. He would be more of the swing trader. So let's give a clear example. Now, what do they use to access the Forex market? Most likely they're using what we call a broker. All right, so they're both connected to the broker. Now, they might say, okay, let's look at GJ, just like the chart we're looking at right now on a daily chart. Two different traders can approach the same asset. And I'll say this first before we move on. Two traders can be long and short and both make money. So that shouldn't even be an argument about who's right in a certain direction or not, because two traders can be long and short and still make money. So where's the argument in that? Because one can be looking at a 30-minute chart and the other can be looking at a weekly chart. All right, so let's get into it. Day trader, swing trader. Swing traders based off the fundamentals. Day traders based off technicals, or the intraday trader. Now, here's the first reason why your day traders lose money or intraday traders lose money that leans more to the technical side. Because the day trader or the intraday trader, what do? They look to get into positions at the top of the day, and they look to get out at the end of the day. So now pay attention to what the day trader just did. Depending on the broker, you got to pay a spread and or a commission. Sometimes some brokers have both, depending on which broker it is, whatever the case is. At the end of the day, when you're taking a position, you're paying a commission or a spread depending on your broker. So, okay, both traders can't get away from that. Cool. So that's day one. They both pay a spread or commission or both, depending on the broker. Okay. One trader is looking to what? Get in and out every single day. So let's just say that this trading challenge between two traders was for 90 days. Let's do 90 days. 90 days, correct? You know what? Let me switch over. Let's look at a chart, because that's more appealing on this video. So let's go swing back to my chart. So we're looking at GJ right now, and we have the two traders. We'll do it here. And 90 days is the challenge. So the swing trader, here's the swing, and here's the day trader, or slash intraday, whatever you want to call it. Now for 90 days, what is this trader looking to do? Get in and out of the market. So depending on the broker you have, for 90 days, guess what the day trader is going to do? He's going to pay a spread or commission for the next 90 days. So we can clearly say 90 times he's paying a spread or commission. Right? 90 times. While the swing trader on the very same day, so this example that I have, because this is a trade that I actually am running right now. I got in a GJ at 140, spot 62. Now, I personally swing trade. I hold positions. So I'm holding GJ, as you can see, for days, weeks on end. So if I take one position, guess what I'm doing? I'm paying one spread or commission, opposed to the day trader that's doing it 90 times. So let's keep that in mind. 90 times he's paying, opposed to one time I'm paying a spread. So that will tell you right there who's going to obviously make more money in the end. And that's just one example, just off the spread. You're paying more in fees and commissions to run a portfolio, while the other guy is just paying one time and he's collecting what we call pips. So from this point on, we're looking at 1,000 plus pips. 1,000 plus pips from the time that trade was entered. Now, every day that goes on, the swing trader, he continues to hold it. Now, if this particular swing trader understood how interest rates work, guess what? The trader would be collecting the swing trader would be collecting 1,000 pips, and he's gaining interest for holding the trade. You want to learn how to do that? Come to jathensinstitute.com. Learn how to get the broker to pay you for holding a position instead of you paying the broker. So let's get back to the example at hand. The first way, the first reason, or the first example that day traders lose money is because as you're going in and out the markets, gambling every single day, you're paying a spread or a commission. And let's just say off of between a 90-day period. The swing trader takes one trade and holds that for 90 days. While the day trader is going to gamble every single day. So number two, how else he's going to lose money? Okay, the normal day trader or the normal intraday trader, they have good days. They might go 3 days in a row. Oh, they're in profit. They're in profit for 3 days. The next day after that, it's a little bit shaky. They might lose a little bit, right? The fifth day, they didn't realize an interest rate move was coming out, which is a fundamental key data. Because you don't understand fundamentals, the move went against you, fell 200 pips. Or you don't understand sentiment, the move went against you 200 pips. So that's another aspect that if you don't understand, a majority of the market knows two aspects, fundamental and technicals. Well, what about sentiment? Sentiment can burn a lot of accounts. For example, my team and I, we were at one point in time long UJ. We were long UJ, and we understand how the Japanese yen currency, the currency works. So we understand if there's uncertainty, that pair could start to catch inflows of traders because it's considered a safe haven. So guess what? We were long at one point in time. The next morning after that, days later after that, Trump released a tweet talking about China. And guess what? The market instantly dropped 100 to 200 pips. Now, if you're coming from a swing trading perspective, you might be able to withstand that drop depending on where you entered and how many pips are moved above you. But the day trader cannot handle that. And it's the funny part about it is you don't know when sentiment is coming. Who knew that Trump was going to deliver a sentiment like that? So a day trader cannot say that they make money consistently. You just make money daily and you lose money daily. But at the end of 6 months or at the end of 1 year, when we look at the final balance sheet, you're in the negative red. Because why? First of all, you're within those 90 days, if you take one trade a day, you pay 90 times in spreads and commissions, and that's one trade a day. But guess what? The average intraday trader may take 3 to 5. So that's 90 times 5. Look how many times you're paying spread and commissions opposed to the swing trader that understands what's going on, takes a decent lot and holds it. Doesn't have to worry about commissions or spread. Only thing he has to worry about is collecting 1,000 pips from the price entered right here. And you gain interest because you understand interest rates. So think about what I'm saying, guys. The day trader is going to go through more psychological breakdown than the swing trader, than the person that actually understands what's going on. Because I've been there, I've done that. December makes 9 years I've understand this market. I've been there. I've understand how it was, how a lot of traders come into the market. Your psychological level is racing in the beginning until as time goes on, you start to become more comfortable, more confident, you become more patient. How did I get to this patience level? By understanding fundamentals. I came into the market as a newbie learning technicals. And guess what? As I started to learn fundamentals, the picture got clearer. So the day trader every single day, 2 to 3 trades, over leverage, technical approach equals gambling. You can do that same thing walking into the casino. And how can you over leverage in the casino? Okay, knowing you don't have this $100 to spend, but you still do it anyway. And then you end up losing because you don't understand that the casino is designed for them to win. You can have days where you walk in to the casino, make a few $100s, but then greed kicks in. Same thing in the market. You can have days where you're having a series of runs, but by the end of the week, you lost it all. And guess who's still going? The swing trader. So this is why day traders will always lose money. As the days go on, you're just going back and forth. Losing money, gaining it back. You're losing more than you're gaining, so you're always fighting for your capital back while the swing trader's still going 13 weeks later, collecting pips and interest, so he's getting paid twice for holding a trade. You guys probably didn't realize that you can do that in the Forex market. There's a concept for that. Where do you learn that concept? Once again, jathensinstitute.com. Learn how to really trade the market. Don't become a day trader and go through a series of wins, because you're going to go through a series of losses. It's just the nature of life, guys. So understand, day traders will lose money until you switch things up. Why are big institutions holding for 3 to 4 to 5 years on a position that I've personally seen? How is that? You have to know something to hold for years. The position that you see right here, from 140 till now to 125, 129, you have to know something to hold that long. I've never seen a technical trader hold for 13 weeks, because technicals only try to get you in and out the game. All right, so appreciate you taking the time to listen to this video on why day traders will lose money. I'm probably going to do a part 2, because I think I feel like I'm not getting all my points out, but I know I have more to say. So look out for a part 2 of why day traders will lose money. Maybe a part 3. We'll see what happens. All right, guys. So until next time, I'll take care, and I'll see you. See you later. Stay Athens.